Good evening. My name is Jackie Knight. I'm the Corporate Training Director for STC, and I'm glad to have you join me this evening for our webinar. This evening's webinar is entitled Self-Directed IRA Investment Possibilities, and we're going to talk about a variety of different types of investments that you can do in your self-directed retirement account. As I get started, I do want to give you a bit of information about STC. We are a retirement plan administrator, so we do not provide legal, tax, or investment advice. We don't represent or sell any securities or investments of any kind. We are not a registered investment advisor, and we also don't represent or endorse any particular investment opportunities. And I will be talking about possibilities for your self-directed retirement account, but we don't represent or endorse these investments. We do recommend that you consult with your legal, tax, and investment advisors prior to making any investments. This evening's webinar is going to cover some basic information about self-directed retirement accounts. We're going to talk about some of the benefits of self-directing your retirement account, and then general guidelines that do need to be followed with all types of retirement account investing. I'm going to talk about the specific LLC structure that FTC uses for each of our clients' accounts. And then we're going to discuss some different investment possibilities that perhaps you hadn't thought of. I will go through STC's particular services, and then I will open the floor for questions. So let's get started with the definition of what is a self-directed retirement plan. What it means is that you are holding your retirement account with an entity, a company, that permits you to choose any allowable type of asset. So anything that is permitted by the IRS regulations, the Department of Labor, ERISA code. So this would include things that some consider non-traditional assets like real estate. In addition to permitting you to invest in a wide variety of types of assets, self-direction also means that you are going to manage your retirement plan's investments. So you are going to make the decisions related to the investments that you hold. For example, if you choose to invest in a piece of property in your retirement account, then you, as the retirement account owner, will be deciding if you're going to rent that property, what the rental rate will be, if you're going to renovate that property, who you will choose as a general or subcontractor, if you're going to put a new roof on the property, if you're going to upgrade the appliances, if you're going to sell it, what the selling price will be. So you are going to make the decisions that relate to the investments that you have in your retirement account when it's a self-directed account. Now, there are a number of different types of retirement plans. A traditional IRA and a Roth IRA are similar in that they have the same maximum annual contribution allowances. So for 2021, those numbers are $6,000 from your earned income with an additional $1,000 if you're 50 years or older, for a total of $7,000 contributed from your earned income. The difference between these two plans is significant in that contributions to a Roth IRA are made post-tax. So that's different than most retirement contributions. Most retirement contributions you make, and then those monies are deducted from your taxable income for that year. A Roth is different. You pay the taxes on the contributions, the money go into the account. With a Roth, when you begin taking distributions once you reach retirement age, which is considered 59 and a half for these purposes, those distributions are taken tax-free. They are not included in your adjustable gross income for tax purposes. So that means that all of the growth over the longevity of your Roth account has been earning tax-free. Now, a Roth account does have a 60-month time period that you need to hold the account before you can begin taking tax-free distributions. But it does have that significant benefit over most other types of retirement contributions. A SEP is a Simplified Employee Pension Plan. I know some small business owners might have this type of plan where they can make both an employer and an employee contribution. Sole proprietors can also use this type of plan. It has a larger contribution allowance. For 2021, that maximum SEP contribution for 2021 is $58,000. So that's from the business that this plan is on, the earnings of this business. The maximum contribution is $58,000. A simple plan is a savings incentive match plan, and it has some different nuances and some different limits. The elective deferral for 2021 for a simple is $13,500. Catch-up provision is $3,000 if you're 50 years or older, so that would be $16,500. I've seen some partnerships use a simple plan. I've seen a sole proprietor use a simple plan. So if you have your own business, you may want to talk to your tax accountant to determine which type of plan would be best for you. Now, on your screen, you'll also see 4 plans that are labeled former employer. A 401k is a for-profit corporate type of plan. 403b, often used by charitable or nonprofit entities. TSA, tax-sheltered annuity. TSP, thrift savings plan. If you formerly worked for an employer and participated in one of these types of plans, then you can move your monies out of that plan into a plan that you currently qualify for. Say, for example, a traditional IRA, or perhaps you have your own business now, and you might qualify for a SEP plan or a simple plan. So you could move your monies out into a different type of plan that you qualify for and then self-direct those funds. Now, a solo 401k is a different type of plan. It was created for sole proprietors, for individuals who are in business for themselves, by themselves, with some limitations. Possibly a spouse could be in the business and very limited employees, but basically a sole proprietor. The solo 401k has some great advantages in that it does give you a Roth provision if you wish to have that included in your plan. So you could have some of your monies designated as Roth contributions, and then those would be earning tax-free. A solo 401k also has a loan provision, and the nice thing about that loan is it does not have to be used for business purposes. It can be used for any purposes as long as it is paid back on a timely basis according to the terms that are set up in the solo 401k document. So a solo 401k does allow a sole proprietor to make larger contributions into a retirement plan with some additional benefits. If you have any interest in that type of plan, do please let me know. I'd be happy to get you some more information. One thing you do want to keep in mind is you do have to have a plan open by December 31st of the calendar year in order to make contributions into that plan from your earnings in that calendar year. Now, if you already have, say, a traditional plan or you're participating in a 401k, you can transfer or roll over those monies into a current plan anytime because you basically have a plan already open. This would be if you don't currently have a plan. You need to have it open, set up by December 31st, 2021 in order to make contributions from your 2021 income earnings. Now, let's talk just a little bit about why you might want to consider self-direction. And probably one of the biggest reasons is that it does allow you true diversification into a wide range of asset types. You can include, as I mentioned before, non-traditional assets like real estate. You can invest in mortgages and notes. You can even have private business investments. So you really can diversify into different asset classes. Not everything has to be in stocks and bonds and mutual funds, which is a more traditional type of retirement plan investments, or CDs. In addition, I mentioned earlier, you're going to choose and control the decisions related to those investments. If you are interested in real estate investments, you can increase your buying power by using leverage. And that means you would your retirement account would actually get a loan and debt finance a piece of property, a real estate purchase. So you can do that in a self-directed retirement account. And because of all of these things, you may be able to earn a higher return on your investments in your retirement account. Now, there are guidelines that must be followed in any retirement account investing. I'm going to go through these in general, but keep in mind that STC's function as a full service administrator is to help you. You don't need to be the expert in all of these rules. But some of the guidelines that relate to retirement account investing are administrative requirements. There are certain things that do need to be fulfilled every year. An annual valuation of your retirement assets needs to be made, and an annual report sent to the IRS, a Form 5498. Detailed books and records need to be maintained for all of the transactions that are going on in your retirement account. So purchases, sales, earnings, interest, dividends, all of those types of things need to be recorded in detail. And then depending on what you own and what state you own it in, there may be some state filings that are required. In a rare instance, a tax return might be required. That would be if a transaction in your retirement account triggered UDFI, unrelated debt financed income tax, or UBIT, UBIT, unrelated business income tax. Both of those things can happen in a self-directed retirement account depending on the type of transaction you do. They are rather rare, but there could be an occasion where they come into play. So you do need to keep that in mind. STC is a full-service administrator for self-directed retirement accounts. So we will fulfill all of these requirements with one exception. We are not permitted to prepare a tax return, but we will give you and your tax preparer all the detailed information they will need if that does come into play in your retirement account. Now, some additional guidelines for self-directing. There are some things that you need to keep in mind. There are a couple of assets that are prohibited, things that you cannot own in a retirement account. The first one is life insurance contracts. Now, there is an exception to that. If you have a solo 401k plan, you can actually own a life insurance contract in your plan, but that's the only exception. And also, always prohibited are collectibles. Stamp collections, coin collections, works of art, fancy rugs of great value. Anything that's collectible is not permitted as an asset in a retirement account. There are also certain transactions that are prohibited. Transactions do need to be for the benefit of the retirement account. So if you're engaging in something that will not benefit your retirement plan, it really is a prohibited transaction. You personally cannot borrow money from your retirement plan. You also cannot pledge your plan assets to secure a personal loan. So I have seen loan applications that will ask for information about your retirement account, but they cannot be used, your monies in your retirement account cannot be used as collateral to secure a personal loan. That is prohibited. You also cannot utilize your personal credit or your personal guarantee to obtain a loan for your retirement account. So let me just elaborate on that a little bit. If you decide that you would like to purchase a piece of real estate and you would like to debt finance it, you would like to get a loan, you would like to leverage that transaction, you can do that, but it cannot be a personally guaranteed loan. It will have to be a non-recourse loan. Now, I do talk about a non-recourse loan. I have talked about it in a previous webinar. That is a very specific type of loan. It means that the lender only has recourse to the property that the loan is on, and no other recourse, not to any other assets in your retirement account, not to your personal assets. So there's no other recourse. So it's more like a commercial loan. It does have generally loan requirements, more like commercial loans, a higher down payment, going to be a higher interest percentage. So if you want details on non-recourse loans, I'll be happy to get you that information. But your retirement account can get a loan, but it cannot be a personally guaranteed loan. In addition to these prohibited transactions, you also cannot benefit any disqualified person with the transaction that you engage in. So let's take a look at who disqualified persons are. First off, you see you. You and your retirement account are separate entities, distinct. You cannot do a direct transaction with your retirement account. If you are married, this would include your spouse as well. Your spouse is a disqualified person to your retirement account. There are other family members who are also disqualified. Ascendants, so that means your parents, your grandparents, your great-grandparents, on up the line. Your descendants, your children, your grandchildren, your great-grandchildren, on down the line, are all disqualified. So that means if your father owned a property, your retirement account could not purchase it from him. If your daughter owned a vacation rental property, your retirement account could not purchase it from her. But lateral family members are not disqualified. So lateral means brothers and sisters, aunts and uncles, nieces and nephews, cousins. They are not direct ascendants and descendants. So they are not prohibited. They're not disqualified persons. So if your brother or sister owned a property, your retirement account could purchase it from him or her. So it's kind of interesting how the rules work, and we'll help you with this so you don't have to keep all of these details in mind. There are also two entities that are disqualified persons. A company, any company, doesn't matter how it's organized, if you are a majority shareholder. Not 51% or 50 point something percent, but a majority shareholder. Or any company if you are an officer, a director, or a highly compensated employee of that company. So keep that in mind. I often have real estate investors who are looking to use their real estate investing expertise in their retirement account investing. If you are running your real estate investing through a business, and that business, you are the majority shareholder or an officer or director, and that business, no matter how it's organized, if it owns a property, your retirement account cannot purchase it from that property or sell to that entity. So just some things to keep in mind as you're thinking about types of investments you might be interested in. Now, SDC does create a very specialized LLC for each of our clients' accounts. This LLC is written, its articles of operation and its organizing documents are all written so that they comply with IRS rules related to a retirement account. So it's a very specialized type of LLC. We use this for each of our clients' account because it does give you some great benefits. It gives you a great deal of flexibility when you are structuring complex transactions. We have clients who have multiple parties to transactions. Sometimes they co-invest with family members, and I'll tell you how that can work and be within the rules. Sometimes they will get a loan. Sometimes they will be renovating a property and have a general contractor who's a party to this transaction. So using the LLC does give you a great deal of flexibility in structuring transactions. It does also give you an additional layer of asset protection because it is a limited liability company. So there's no access to any of your other assets that you might own personally or in your family. It also gives you checkbook control over your retirement fund so that you can move quickly when a good investment opportunity comes up. We know they can go very quickly. Now you'll notice that I have checkbook control in quotes, and that is because we at STC do not give our clients the checkbook for their account. Some companies do that. We do not. The reason we do not is unless you are an expert in all of the rules related to retirement account investing, you could possibly get yourself in some difficulties and by engaging in a prohibited transaction. And the penalties for engaging in prohibited transactions can be very severe, up to forfeiture of your retirement account and it all suddenly being a taxable distribution to you. So rather than do that, what we do is we oversee, administer your retirement account. We review all of your transactions, and we can do that review same day or next business day once you get the paperwork to us. We'll look through it and make sure it's all good, you're not engaging in any prohibited transaction, and then we can same day or next business day wire those funds, get those monies to the seller so that you can own that property in your retirement account. So what you really have is you have experts looking over your transactions. So I call it protected checkbook control. You can make an investment quickly, but you have experts looking over it for you. This LLC structure also simplifies asset titling. This is very helpful if you're interested in a real estate transaction because you don't need to send the real estate closing documents to our office where they sit on somebody's desk in their inbox while they're away on vacation for a week. And then they come back and then they look through them and they go, yes, this is okay, and they sign up and they send them back. That is not the case with an STC account. You can actually go to closing on behalf of your LLC retirement account because you are the investment co-manager of this LLC. So you go to closing, you sign the documents, and then you send a copy of them to us. So it really does simplify asset titling and transfer of title as well. Also, this structure can assist in pooling monies from your retirement account with other co-investors to co-own an asset. So it makes it the pooling process straightforward. So what I mean by that is your retirement account does not have to fully fund the investment. Let's say it's a large property, maybe it's even a commercial property, and you don't have the funds in your retirement account to pay for the whole cost. You could be partnering or pooling with others to own a portion of that investment. So let's talk about who you can partner with. And the first three people I bring out on the screen are yourself, your spouse, and family members. Now you'll remember I just told you that you, your spouse, your ascendants, and your descendants were disqualified persons. And that is true, they are, but there is a way to partner with them that is within the rules and is permissible. So I'm going to show you that on the next screen, but that is a possibility, and we can help you structure your transaction properly so that you won't violate any of the IRS or Department of Labor rules. You can also invest with investment colleagues, you can invest with LLCs and investment syndications. And in addition to co-investing, you can also be a source of funding from your IRA. So you can loan money to someone, you can loan money for a real estate purchase, you could loan money for business working capital, you could loan to finance a down payment on a property. So there are lots of different types of transactions that you can do in partnership with others. Now let's take a look at this schematic and let me show you a little bit more about this partnering or pooling and the advantage of the LLC. In this schematic, you'll see on the upper left, your current custodian is listed. So you have decided you're going to open an account with STC, and you'll fill out some documents that will direct your current custodian to transfer or roll over your funds to our self-directed custodian. While that is happening, we will be creating an LLC in the state of your choice that's going to be owned by your retirement account. Once the LLC is set up and the money has reached our custodian, then the money will be moved to a bank account that your LLC has access to, and you're ready to begin investing. Now, in this schematic, you can see that you have 3 investments in your retirement account. two of them, investments 1 and 2, are wholly owned by your retirement plan. Maybe one is a real estate property, maybe one is a loan to someone, maybe one is a CD, or you could even have a brokerage account as one of your investments. But you'll notice investment 3 is a little different, a little interesting. You'll see that investment 3 has 4 co-owners. Investor number 1 is your father. Investor number 2 is your daughter. Investor number 3 is some of your personal money, money outside of your retirement account. And then investor number 4 is your retirement account. This is a permissible, viable transaction as long as you are co-investors at the inception of the purchase transaction. And that's what we can help you structure properly so that this would be a viable transaction. So investment 3 happens to have 4 owners. One of them is your retirement account. Now, in choosing an investment, you have a lot of options with a self-directed account. I'm going to bring out on your screen a listing of different types of real estate investments that you could choose. You can invest in single or multifamily homes, vacation investment property. And let me elaborate on this a bit because some people get a little excited / confused about this. If you do decide that your retirement account is going to invest in a vacation property, you must keep in mind that you cannot personally use it. Your parents can't use it, your children can't use it, you and your spouse can't use it. Now, your brothers and your sisters and your aunts and your uncles and your nieces and your nephews, they can use it. But all those rules about disqualified persons are going to apply to these investments. So you just want to keep that in mind if you're investing in a vacation property or even a single family home. I mean, you could purchase a single family home and you could rent it to your brother, but not your mother. So just want to keep those things in mind, and we will assist you with helping you know what those ins and outs are. You could also invest in tax liens. Some of those in various states and jurisdictions have very high interest rates that might be desirable to you. You can invest in raw land or building lots. You could invest in a commercial building, and you could join other investors in real estate syndications. So again, you don't have to fully fund these. You could lend money or invest in mortgages. You can invest in precious metals, private business and operating businesses. Here I want to also add, you do need to keep in mind if you're going to invest in a business, you cannot personally work for that business or provide any service for that business. It does need to be a passive business investment. You can also invest in the Forex market, foreign currency, options, futures, and then of course you could have a portion of your self-directed retirement account in a brokerage account, stocks, bonds, mutual funds. So you can see that you have a wide range of different types of assets that are permitted. And most financial planners think that by diversifying, you have the best type of portfolio. So a self-directed account really does let you diversify as much as possible. Now I'm going to talk about a few investments that we have seen and some example investments just to help you start thinking through some possibilities for your retirement account. So we had a client who invested by purchasing a property, and then she rehabbed it and she sold it. Now she had $500,000 in a self-directed retirement account. She actually moved it from a corporate 401k plan, and I think maybe a couple of them, and put them in a self-directed account. And then she purchased a property for $330,000. She spent $140,000 to rehab that property, and then she sold that and increased her retirement account by $85,000. And she did that in under 1 year's time. So that was a really nice return on her investment. We also had and have several clients who invest in rental property. So this is an example of someone who purchased rentals, and she really purchased them for appreciation. So she had $500,000 in her retirement account. She purchased 2 rental properties. She put approximately $500,000 down, and then she took out remainder non-recourse loan. That's how she paid for the remainder. So she did have loans. She, at the time that I last checked into this, was renting for a break-even plus cash flow, and then she was holding those properties for appreciation. Now, by this time, she may have sold those because the market has definitely elevated in many areas, and so she was holding that property. When she sells it for appreciation, all those monies go back into her retirement account, and all of those monies that she earned are now in her retirement account awaiting her for her reinvestment. You can invest in real estate in foreign countries if you wish. We have had clients who's invested in a vacation condo in Costa Rica, and another who invested in land development opportunity in Mexico. So those are possibilities. Now, this was an interesting investment. This was a client who had some specific expertise, and he used that in his retirement account to benefit his retirement earnings. So what he did is he purchased building lots and then he resold them. So initially, he had a Roth account that had $11,000 in it. He purchased building lots for between $5,000 and $10,000. So he would purchase the lot, then he would market it and resell it. And in 18 months, he did 9 of these transactions. So again, this was his expertise. He knew how to do this. He used his expertise in his retirement account. He increased his retirement account value over that 18-month period to over $300,000. And, the wonderful thing for him is that this was a Roth account. So when he waits till retirement age to begin taking distributions, all of those earnings are going to be tax-free. Now, my last understanding was that he used this cash to make an investment in a commercial strip mall. He took out a loan. So he's now working. He understands commercial properties and building lots, and so he's using that to his advantage. We did assist him in working with his local bank and helping them understanding what non-recourse loan requirements were. So we can also assist you in that way if you find you have that need. This is an example investment of a builder who has building lots. And this is a 30-lot subdivision. It's 50% complete, and he's experiencing some financial difficulties. So what he does, he wants to put the remaining lots for sale at $30,000 each. So you and 4 investors each pool $100,000 from your retirement account, and your plan is to hold these lots for 3 years and then sell them for $60,000. Now, the purchase price of those 15 lots would be $30,000 each, would be a total of $450,000, and then you're going to need some money to carry the lot, taxes, etc. So $50,000. Your sales price, you plan is 15 lots at $60,000. That's going to give you a gross of $900,000 when you sell. When you deduct your cost, that would give you earnings of $400,000 over that 3-year period. So between 5 investors, each of you would earn $80,000 per investor in this particular type of example. So if you happen to be others who are investors who are looking for opportunities, you might want to think about how you might be able to combine or pool your funds and what you might be able to do if you have a larger pool of money to work with. In this example, this would be an 80% return over a 3-year time period. Now, this is a client we had do an investment. This was an investor guaranteed loan. So the retirement account of our client made a loan. They put $100,000 into a self-directed account with us, and then they loaned that money to an investor, happened to be a real estate investor, for a guaranteed return, annual return of 10%. So there was a promissory note that was completed. Now, the terms of this note would be determined and agreed to by you, the IRA account owner. And you would want to be sure that, well, you would probably want to be sure that you had security for your note, perhaps a lien on a secured asset of some type. But this is a type of asset that you can own and earn, a great return, and you're lending money to someone. This was another client investment into a loan pool. The client IRA contributes $50,000 to a loan pool. Loan pool is a company that lends money to professional rehabbers. So they always have first position on the loan. So it's secured by property. And then the net earnings on these loans are paid back to the retirement account quarterly. At one point, I know this was earning about 12% or more annually. So that might be something fairly safe because it's a secured loan that you might want to consider, something like that. This was another interesting client investment. This one's someone who invested in natural gas drilling. In this case, it was a retirement account investing about $35,000 in a syndicated oil natural gas drilling project. So there were a number of other parties who were also investing. They were doing 5 drills in a particular location. If they did hit a well, had a strike, then they were going to need an additional $5,000 to $10,000 investment from each investor to cap that well. Now, if no oil or gas is found, this investment is lost. I mean, it is something to consider. You do always want to consider that there are risks as well as rewards in investing. If there is a strike, then the investors are going to receive royalties on producing wells. Now, in this particular client's case, they did have strikes on the first 2 drills. So they had this additional investment, and now they're earning royalties on the production of these wells. This is an example of an investment because I do want you to understand that you can sometimes make an investment that can also help out a family member. In this case, it's a loan to a family member. So you make a loan to a cousin to purchase a home. This cousin is not a disqualified person because it's a lateral family member. She is recently divorced, which upsets her financial security, and she can't qualify for a loan on her own. She needs a couple of years to get back on track. The purchase price is $150,000. She does have 10% down from the sale of her prior home. You look at this neighborhood, you think it's going to be a good investment, there's going to be good price appreciation. So you offer your cousin an interest-only loan at 8% with the principal due in 2 years. You would earn nearly $11,000 in interest per year. And of course, you would want to have a lien on the property so it would be secured by real estate. So it is possible to help a family member and still benefit your retirement account. Now, this is an example of something that might be of interest to you. You can invest in a private business. So this is an example of somebody investing in a business where someone already has a proven track record. This is an expansion of a furniture business. A neighbor has a profitable store and they want to expand. They need money for inventory and working capital. So your retirement account invests $50,000 for a 1/3 profit interest. The new store makes $100,000 a year, so you get 1/3 of that, or $33,000. After 5 years, you sell your interest for $75,000. So over 5 years, that store has been growing. It's continued to earn, and now the owner of the store is going to pay you back. So you sell your interest in year 5 for $75,000. You would have had earnings of $190,000 over 5 years. Your account would have grown from $50,000 to $240,000. So this is an example of a loan. Now, if you owned part of this business, if you were purchasing part of this business as an owner, that's different, and that could trigger UBIT, unrelated business income tax. So you do want to keep in mind that there are some nuances to investing in businesses, and our client services department can help you understand what those differences are. And if taxes are going to come into play, then you can consult your tax accountant to determine how that might affect you. This is an example of a group investment that some of our clients did. There was a syndicator who purchased properties throughout the country, and then he set up LLCs or partnerships with small groups to invest in those properties. They were often mixed-use buildings, so there might be residential on top of commercial, multi-story buildings, and the investment might be between $100,000 and $120,000. So this was interesting. He often did groups of 5 partner investors, and that was just a type of group investment where then those investors would reap the earnings off of those rentals and those commercial properties. This was another developer type of investment. This was a developer in a large metro area who purchased a high-rise buildings, and then he converted those properties to condos. So an investor from their retirement account would buy a condo for rental, and that investment might be anywhere from $200,000 up to $1 million, depending on which floor and how it was done, which building. And this particular developer had investment programs ranging, from 18 months up to 3 years. So the minimum investment in this case happened to be the price of one condo, but some folks did pool funds with other investors to purchase a single condo. And then, based on your percentage of ownership of that particular condo, you would earn that percentage of the earnings. So another type of investment that you could partner with others in. Now, this was another client investment where a syndicator pooled investors' funds to create a loan, and the loan was made to a developer of raw land. So the loan was secured by the land. In this particular case, the minimum investment was $25,000. So this syndicator was pooling a number of different investors, investments of $25,000 plus, and then making that loan to the developer and earning on interest from the developer as he's using that money to make the land usable. So just some different types of investments that you might want to consider and look into. There are a wide range that are available to you. I do want to walk through STC's services. As I mentioned, we are a full service administrator. So we do create the retirement account LLC structure setup for each of our clients' accounts. We offer you that protected checkbook control that I described. We have CPAs and attorneys available to answer your technical questions. Our client services department is wonderful in giving you all of the guidance and information you need in order to make sure that your transactions comply with the IRS rules. We handle all of that back office support I talked about. We will prepare those annual valuations. We'll give you financial statements each quarter of your account, and you can see a cash flow statement. You can log on to your account and check it out daily. We will supervise the regulatory reporting and will oversee that annual valuation for you. So our goal is really to provide all of the administrative services, setup function, offer you guidance and in transaction compliance. So really all you have to focus on is finding the best investments for your retirement account, the ones that you want to choose. Now, it's very simple to set up an account with STC. Just talk with your representative. You can talk with me if you like. Review your current retirement accounts. Discuss what your investment objectives are. get any questions answered, and then complete some client paperwork, and we can get you started. So basically, the question is, how can we serve you? Maybe you want to open a self-directed account now. Perhaps you have clients or colleagues who might be interested in self-direction, or maybe you need some more information. So I will put this information up on the screen for you, our website, stcira.com, our corporate number, and then if you have specific questions or would like to know more about how to get started, please get in touch with me. My email address is there. I want to spend a few minutes now answering some questions. I have just a few minutes left, and I did get a few questions prior, so give me just a moment, and I will also take the questions that you have entered. Once my account setup is complete, what does STC require from me to purchase an investment, and what is the turnaround time? Okay, that's a great question. We simply need one of our forms. It's called a Request to Transfer Funds form, and that will indicate the type of investment, the dollar amount, any necessary backup. So if it's a real estate purchase, a promissory note, real estate documents, as long as all that paperwork is in order and we have it by our 2 p.m. bank cutoff, that's 2 p.m. Eastern time, then we can generate a same-day wire transfer to the seller and we can purchase that investment for your account. I should also add, if there are any questions, if we have any questions, we'll get in touch with you right away. We review documents as soon as they come in. So you can email them or fax them, however you like. And you can call and talk with our client services department as needed. And if we've missed the deadline, the 2 p.m. bank cutoff, then it would be next banking day funding for your transaction. Okay. I want to start investing in real estate, but I don't have enough in my IRA to buy a property outright. Do I have any other options? Well, yes, a couple that I mentioned. You could partner with others that have funds and co-invest in an asset. You just have to be, of course, cognizant that they can't be disqualified parties. But even they can be if it's done at the inception of the transaction. So we can help you walk through that. Another option is to borrow money to purchase real estate, and then that would need to be that non-recourse loan I mentioned. And then, of course, another option, it's not quite the same, but you could also make a loan to somebody who was going to purchase a property and, stipulate the terms of that loan and then put a lien on that property so your loan was secured. So it's not quite owning real estate, but it is has the potential to own real estate if they don't abide by the terms of the loan. Let's see, if you have a rental property in your account, who does the renter send their rent check to? Well, the answer to that is it really depends on if you are using a property manager or not. We do highly recommend that you use a property manager because that will keep you at arm's length distance from the transaction in your retirement account. So typically, if you're using a property manager, they will collect the rent from your renter, and then they will deduct the amounts that are owed to them for their services, and then they will forward the remainder to us payable to your IRA LLC, and then we will deposit those excess funds into your account. If you're not using a property manager, then the checks need to be made payable to your IRA LLC, not to you personally, but to your IRA LLC, and then mailed to our office. They can mail the check to you, but then you'll just have to turn around and mail it to us. So you need to keep that in mind. So if you're using a property manager, they'll make their check payable to the property manager, and then the property manager will remit the excess funds to us in the name of your LLC. Okay. if I want to put IRA money into a self-managed stock brokerage account, can I? Can I actively trade in that account with IRA funds? Yes, you can. You can open a brokerage account with any company that you choose. Do keep in mind that the account must be opened as a business account, and it needs to be in the name of your IRA LLC. And then we will ask you to send us copies of your monthly statements, because we will need to ensure that you haven't made any deposits or taken any withdrawals personally, because you have to keep in mind this is your retirement account. So you can do it, and we can help you manage that. What state would my LLC be incorporated in? Actually, we are headquartered in Maryland, but you are not required to use a Maryland LLC. It can be any state that you would like. We have a registered agent company that we can use, so we can assign a street address in the state that you'd like if you don't have your own registered agent. So it really, any state, you may want to talk to our operations director when you're setting up your account with us, and they can help you determine what state, if there's any reason to choose one particular state over another. Okay, one last question. Does STC choose the terms of my loans? You remember that I mentioned you could make loans in a variety of different ways as possible investments. The answer is no, we don't. This is truly self-direction. You get to choose the terms of your loans. What our client services department will do is we will make you aware if any of the terms of your loans might raise a red flag in an IRS audit. If you are making a loan to a brother or a sister for 5 years at 1% interest, that might look a little fishy, because that's not a normal interest rate that someone could get on a loan. So we would let you know that. The IRS might wonder about that if they did an audit of your retirement account. So we won't tell you that you have to change that rate, but we will inform you if any of the terms might place your retirement account at risk with the IRA. So we'll try to help you with that. Okay, well, thank you so much for joining me this evening. I do appreciate it, and I hope that you will get in touch if you have any more questions, and if you're interested in opening an account with STC, we would be happy to help you get started with that. We do educational webinars once a month, and I hope you'll join us next month. Thank you. Good night.